Good afternoon, everyone. Welcome to the second webinar on impact investing and ESG. Today, we're going to talk about how we can effectively measure impact. I'm very pleased to be joined by Dr. Barnabas from Refinitiv and Financial Analysis Platform. And by Katie, Business Development Manager from 60 Decibels, impact management company.
Hello.
So today's webinar will consist of two parts. The first part will have three sort of mini presentations by Barnabas, Katie, and myself. I will introduce the concept of impact measurement and to talk about different challenges we encounter when we try to build an impact management process. And Katie will talk about how to implement the impact measurement and management in practice and provide some concrete examples. And last, Barnabas will talk about measuring ESG factors. And then the second part of the webinar will be a discussion where we'll talk about the latest trends on impact measurement. We will also address the most common asked questions by some of our investors. So the key question is impact measurable? As we start the first slide, I mean, I trust in the loyalty of my audience, and I'm sure you guys have all seen or watched my previous webinars on impact investment, and remember that at minute 12 on my this chart from minute 12 from my previous session. Well, please make sure to go to check because there is a recorded version available. So this chart shows different types of sustainable investing from ESG, negative screening, to impact investing. So what do they have in common? Besides, the intention of doing something good and providing an impact to society, there's another common factor that the data matters. As you can see on the bottom of this chart, but also highlighting on the next slide, the three measurability, it's one of the key components that define actually impact investing. So intentionality, of course, we're talking about the investor's intention of making a positive impact. The additionality, which is the second component, it's also another important consideration in thinking about impact. It refers to whether the target social outcomes would have occurred without investment. So the investor level additionality is additional impact that investor is creating on the enterprise. And enterprise level additionality is additional impact the enterprise has on the society. All this needs to be measured. There's a lot of discussion, among impact investors on how to measure impact. For example, like 70%, 75% actually of all the impact investors that participated in the June survey, the 2019 annual impact investor survey, they see the certification of impact measurement and management practice as either a very significant or moderate challenge to the growth of the impact investing industry. So understanding how to effectively measure and manage impact is critical to ensuring impact investors are achieving their desired impact results to address some of the biggest social and environmental challenges. So impact measurement is actually quite complex in practice and varies in approaches and rigor with a number of different methodologies and practices. But impact measurement and management need to be integrated throughout the whole process, and it's an interactive process. So we do have to keep a few questions in mind throughout the process, like is the data collected, is it properly assessed, properly reported? So on this slide, you can see the 5 dimensions of impact. So everything we do has impacts on people and planet. And after 100 of conversations among the practitioners, the IMP, which is the Impact Management Project, is a non-profit organization, has reached a consensus that impact can be measured across 5 dimensions. So what tells us what outcomes the enterprise is contributing to, and how important the outcomes are to the stakeholders. Who tells us which stakeholders are experiencing the outcome and how underserved they were before the enterprise's effect. How much tells us how many stakeholders experience the outcome and what degrees of change they're experiencing and how long they're experiencing the outcome for. Contribution tells us whether the enterprises or investors' effort resulted in outcome that would likely be better than what would have occurred otherwise. And last one, the risk tells us the likelihood the impact would be different than the expectation. There are different categories of data across these 5 dimensions, and they represent the building blocks of impact management framework. For example, the SDGs that everyone talks about fall into the category of what. So the outcome might relate to one or more of the SDG goals. And on this slide, you can see, according to the 5 dimensions of impact, then you can actually define the intention and the intentions and the impact. So depending on their motivation, the investor's intention then range from broad commitments. They can be classified as either A, B, or C. So at the minimum, the investors can choose companies that act to avoid harm to their stakeholders. So for example, companies that decrease their carbon footprint or paying an appropriate wage. So these companies are effectively mitigating their reputational and operational risk. That's what we refer to as ESG risk management. And then investors can also choose companies that actively benefit stakeholders, which is second category, B. So in doing so, they're trying to achieve financial outperformance over the long term. And we often refer this as pursuing ESG opportunities. And many investors can go further. They invest in companies that are using their full capabilities to actually contribute to solutions to serve social and environmental issues. So these are normally, the impact investors investing into the social enterprises. On the next slide, then you can see what we have adopted at Dolfin level. So often, the methods of big and independent impact evaluations for government-funded projects, they rarely can be used for private sectors, especially for private wealth management companies. So we do need to understand what is important, what's more relevant for our private clients, and also at the same time feeding important business intelligence back to the companies. So there is no tool that can be applied from a one-size-fits-all perspective. So we follow the general guidance that's been provided by key impact organizations such as IFC, with its operating principles for impact management, GIN, the Global Impact Investor Network, and its tools called IRIS, and IMP, which I've just mentioned, the impact management projects. So then we integrate the impact measurement and management principles throughout the investment cycle. And we also did mention in previous webinars on impact that we have mapped different impact themes to our Dolfin traditional investment teams and linked them to the relevant SDGs. What we also trying to do is we try to actively engage with companies. So we have learned that it's very important to involve the businesses early in the very early stage in what is being measured and why. So the companies, the entrepreneurs, they also have a full understanding of what is being required, because the measurement also helps them to grow their businesses. So it's important to consider in advance how to address possible conflicts, also that can rise between commercial and social impact. On the next slide, I would like to show you the impact management process with all different key steps. So there are a few questions that we need to ask and address when we're building the impact management process. How can investors measure impact in a way that allows them to get better understanding of their investments, but also bring concrete business benefits to their investee businesses? Can measuring impact add value to the business, or does it present, or is it a burden for the business? how can measuring impact balance the need to be accountable, but also considering at the same time the day-to-day realities of the companies being invested in. So some of these points will be also addressed in the second part of the webinar during the discussion. So to start with, the very first important step is to identify investors' impact goals. So we need to set the goals and the expectations at the very beginning. The goals should consider the effects that investment has on people and on the planet, and try to balance investors' expectation for risk, return, and liquidity, and impact. So what do investors actually want to achieve on the impact front? This is a key question that, that both investors and fund managers, they need to understand in the very first place. And afterwards, to set appropriate metrics and set targets, investors should use the relevant output and outcome and different types of metrics to set the targets. These will also use the later stage to calculate to assess the performance for monitoring purposes, and these will be also the targets against which we will measure the success of the impact. Then as a second step, we'll convert the goals into investment criteria, and then define investment strategies accordingly. So there are many different ways to achieving impact goals and meeting expectations. We should always consider the right strategies that make the most sense for the portfolio, in investment expertise, and mostly what the private clients demand. So it's very important to use evidence during this stage, and all the strategic goals should be linked to evidence. And then after this, we can start the due diligence, to screen different companies. Different scores will be assigned to different companies according to across the 5 different dimensions. And then, of course, there are also additional considerations that we need to think about during this process from investment perspective, such as asset classes. So either should we choose equity instruments or fixed income? In terms of geography, so which regions would you rather invest into, developed countries or emerging countries, and different impact themes and SDGs. So then afterwards, the data collection can start. Try to collect the publicly available information as much as possible, and also get the directly information from the companies. Katie will talk about this more in detail in her section, about how they collect the data and how they manage the data afterwards. And then we can then make the data cleaner, and pick the most relevant data, and then also assess the performance afterwards. So impact measurement and management is not just about counting metrics, but it also means considering information about risks, returns, as I have just mentioned, but also improve the investment decision making. This including the feedback, embedding feedback loops through the entire life cycle of investment, also incorporating feedback from all the affected stakeholders, and disclosing the impact performance data in a very clear and consistent and comparable way. In fact, the last 2 steps of the process will be monitoring and reporting. Especially for private clients, it's very important to be able for us to report, to communicate in a very straightforward and clean and transparent manner. As you can see from the next slides, which shows the last 2 steps of the process. So to truly measure impact, a data collection strategy needs to focus on building understanding of the change actually experienced by people and the planet, and the meaningful impact measurement process involves asking the right questions, looking at what the data is saying over time, and in some cases also confronted different truths in case where the positive impact is less than anticipated. So With that, I'd like to conclude my session and perhaps pick up some questions from the audience. There has been a big push on disclosure in the past decade, predominantly among public mid to large cap companies who can afford to gather this data. And geographically speaking, this has been predominantly in Northern and Western Europe, as well as the US, but less for the emerging countries, where you have more state-owned companies. So how are we seeing changes in the emerging market space? And if so, what will it take? Perhaps, Katie, this is more a question for you, perhaps?
I mean, yeah, because I mean, our approach is very much working in developing countries where we're seeing quite a drive from companies and impact investors for better beneficiary level data. And that's really driven, I think, by the desire of the companies to understand better and the investors to make better decisions. I think in the kind of mid to large companies where this question was driven from, it's much more regulation driven. And I think actually really in order to kind of change the market, that needs to happen at both ends, I think, necessarily. I leave Barnabas, because I think operates in this sector a little bit better than I do.
Yes, look, I mean, this area is quite on the frontiers of a frontier kind of topic anyway. So, you know, finding ESG data in general is not the easiest. And of course, finding good impact measurement data is even more difficult. And generally, this is the information sharing on this is not regulated. Luckily, this is a good topic to talk about for larger corporates. So, so if there is impact investing going or happening in the value chain of companies, then normally these are shared in CSR reports or there should be a good incentive to share that in CSR reports, because this is also good for PR for companies. So I would hope that, you know, when companies really do enter into this space themselves to, you know, create shared values through developing services and being more part of their communities and of course adding to circular economies, then this would be coming more on board as such. Hope this answers the question.
With that, we can move to the second section where Katie will talk about the implementation of impact measurement.
Sure, thank you, Annie. So my name is Katie Mountain. I work for an organisation called 60 Decibels. So we deliver impact measurement and insight services for funds and foundations globally. So I'm going to talk for the next 5 minutes or so, sharing a bit about the approach that we've developed over the last 5 years to do impact measurement and how we're turning those into actionable insights that help funders and companies to make better decisions with impact in mind. So a bit of background into 60 Decibels. We used to be the impact team within Acumen, who are a global impact investment fund, where originally this approach was developed as their solution for how to measure and manage impact. But we've since been serving more and more funds in the market. We became an independent organisation this time last year. So we're working with over 65 different funds and foundations and over 500 companies globally to help them to understand their impact performance. So like I said, I'm going to share a bit about our approach so you can understand how we do this. I'll share some examples of the kind of data that we have generated at a company level and at a portfolio level, and start to show how that can be used for impact management in terms of kind of embedding decision making. Essentially, at the heart of what we do is about beneficiary level data collection. So we conduct surveys with end recipients of the products and services invested in to find out, in line with the impact management project that Annie previously presented, helping companies and their funders understand who is being reached even with these products and services, what impact is being created, what changes are occurring, and how significant they are to the people we're trying to reach. Really at the heart of what we're trying to do and our mission and what we'd like to help support the market to do is really to listen to people's lived experiences and using that data to help organisations to measure and manage their social impact. Really, we believe that the end beneficiaries are really the people that we are there to serve, and we want to put them therefore at the heart of our decision making, our planning, our investments and our monitoring. So if we go to the next slide, talk a bit about some of the fundamentals of our approach and how we do this. And a few things that have been really important to us and the funds that we work with that are worth sharing in terms of where we've achieved most value out of the impact measurement approach. First and foremost is that it's about standardization. We need to be working with a set of standardized approaches and metrics in order for us to really understand what performance looks like over time between companies. And to do that kind of performance analysis that can be so valuable, there needs to be standardization, like I say, in the approach and the metrics that we're using. The approach needs to be repeatable, and in order to do that, we need an efficient approach that can be conducted cost effectively at scale in a way that is repeatable. And the way that we've done that, so we have developed a set of standardized tools. So we've got a set of core indicators that we use across all projects that we run. And we've also developed a set of sector-specific modules diving into some of the most important areas, for example, of energy, FI, education, and thematic modules that can be applied in areas like job quality and gender. Then it's next about developing the capabilities to gather this data. And for us, the way that we did that is essentially we wanted to make sure that we did local data collection in the countries that we worked in. Predominantly our funds are working in developing countries. And we've developed capabilities that allow us to do remote data collection, but locally. So in order to do this, we've trained up over 280 local enumerators in different countries that will do remote data collection. So what that means in reality is that they will be surveying the beneficiaries of the organisations that we're gathering data for, predominantly over the telephone in local languages, local dialects. So all of that remote data collection can be done pretty effectively, pretty low cost and pretty fast. Typically we can do a data collection in about 2 weeks, end to end. One of the things that provides real value to the funds that we work with is that the metrics and the insights that are gathered are a mixture of social impacts as well as business insights. So when designing impact metrics and looking at the kind of insights that you're going to invest in gathering, it's important to think through the value that they will bring to an organisation, the decisions that they can help you make. And for us, that predominantly has been a mixture of both social and business that we can provide. Particularly important, like Annie's already highlighted, to align as much as possible with what is already out there in terms of metrics. So looking at GIN for metrics, for example, looking at national data sources and methodologies that you can align with to make sure that you can, where possible, compare performance data to what's already out there. And the last thing that's been really key value add to our approach that I want to share is the ability to benchmark impact performance data. So one-off impact studies will give you great statistics, some interesting insights about a particular investment. But what's really valuable is if we can benchmark people's impact performance. And for us, we've been able to do that by using the same measures and metrics time and time again with hundreds of companies and thousands of end beneficiaries. We can benchmark an organisation's impact performance against different metrics in comparison to their peers. It's important to look at that in the context of comparing as much as possible like for like. So within sectors, within regions, having a look at how data compares across different investments really helps to set into context actually therefore how does that organisation perform in comparison to others? Where can we identify areas for improvement? It's been a huge value add for investors and companies in terms of driving decision. So really, as a summary for us, it's about standardization, efficiency, repeatability, and comparability. This is where you're going to get the most out of your impact measurement and be able to use it to manage your impact and make decisions. So here I'm going to go through a few slides to show some of the data that has been generated and kind of bring some of what I'm talking about to life, really. This is an example of the data we've collected on the who dimension of impact. So how do you understand who is being reached with the products and services that you're investing in through your many investments? And for this, we've been using the PPI methodology to understand particular income brackets of the people being reached. And this is an example of how, if we do that across multiple companies in a way that we can compare it to national data, this is what allows us to start to identify how different companies in the portfolio and the portfolio overall are performing. So you'll see the different individual lines or individual companies and showing the poverty reach of those companies. So what that means is how many people in specific poverty brackets is this company reaching. It shows whether you are over or under penetrating a particular income sector, and says something about the inclusivity of these investments. There's national data from the World Bank in each country, so you can also see there the country average. That can also be broken down rural and urban as well, if those kind of level of detailed insights are useful comparables. We've also there identified the portfolio average. So here, this really allows us to start to identify, okay, who are the most inclusive companies, and then maybe start to dig into the why and see what we can learn from this. And so if I move on to the next one. So this is an example of impact data we've collected that's really answering the what question. So what impact has been generated through the investments? And this is an example of us collecting data across a fund's portfolio. This is for an FI portfolio. We're using dummy data here, but a financial inclusion portfolio, and really identifying the average across the portfolio, what impact has occurred through those investments. And here we can start to see which areas the portfolio has particularly performed well in, can start to compare this and contrast against the intentions of the fund and the strategy that was implemented, how well that has played out in reality from like I say, the beneficiary level. And if we go on to the next slides, what we can do, we can break this down even further and actually look at this at a company level. And here I kind of bring to life all of the things that I've articulated around the comparable performance. So we've got each individual company and how they performed against each of the core impact goals of that fund. You'll see the red in the middle is the portfolio average. So really the kind of comparator here in terms of benchmarking is actually the average, and where we can identify where organizations are over or under performing. And really, I mean, this is where you can start to turn impact measurement into impact management. You can have a look across the portfolio and understand how it's performing, and really that's the measurement side. Did my portfolio perform in line with my expectations? Do I have enough data to understand what impact has occurred? And then turning that into management by really delving into these insights, benchmarking performances like this and doing this kind of comparable performance, we can start to identify which investments, for example, are the most inclusive, what factors are most likely to deliver certain impact goals, and have that be the route by which you feed that back into decision making, both in terms of strategic decision making, investment decision making, and active portfolio management with this data in mind. And really, like, identifying these kind of lessons and making decisions and actions from them is where the impact is created. Data and measurement alone won't create impact, but the decisions that are made can really help to drive some of the improvements that you'd like to see when it comes to maximizing impact. So that's what I was going to share in terms of the approach and some example insights. I'm really happy to answer any questions about the approach and the data. I added this at the end of the presentation as a way just to share. We have been collecting data on the impacts of COVID-19 across the developing world, and all of this data we've made available in online public dashboards, which for those who are interested in using that data to help them to plan and respond, I wanted to highlight that this resource was available publicly for people to use, particularly important in this time. I wanted to highlight.
Thank you, Katie. Let's see if there are some questions maybe we can answer, pick up another one. So there's a question from the audience. How can I measure the costs of investing for impact versus traditional investing? Maybe I can. I'm not really sure what the cost in this question means, but maybe I can make a quick comment on this one. So it depends if it's a cost for the investors or for the companies, because as I've mentioned earlier, some of them is impact measurement. Does it represent a cost process for the companies because it's additional requirement? Is it a burden for them? I think previously it was seen as sort of additional requirement, but now, especially during COVID and after COVID, having incorporating all these ESG factors or impact inside the normal business operandums is important. So it will be incorporated already, I think, in their operational costs. So going forward, I don't think it will become additional costs for the companies. And from the investor perspective, again, I don't think it's an additional cost because for me, in the future, it will be compulsory to include all the ESG factors and impact factors in the financial analysis. So it will be pretty much standardized and it will be compulsory across the industry. What do you think, Katie and Barney? Do you have additional comments?
And there's also, we get asked this quite a lot as well in terms of, there is a cost to doing this kind of impact measurement and gathering this kind of data. And who should pay for that? Should it be the company? Should it be the investor? And really, I think I have quite strong opinions about that, but just to say the one line, I think really is to go back to, this is an investment in terms of generating this kind of data, obviously comes at a cost. And like I say, you need to design an approach that is low cost and effective as possible, but it still comes as a cost. But really, hence, every single data point and metric that you gather needs to be useful for an organization. It needs to bring your company value, and that is the return on the investment. And some of the litmus tests we go through with companies is really that test of kind of, what are you going to do with this data point? What will it allow you to understand? What decision can it help you to make? And so really making it a good investment. And so the company and the investor should see value come back from the investments that they've made for this data. That's really, and a company and an investor should see value in that, and kind of having that be part of their decision making going forwards.
Thank you both. And with that, we can move on to the next section with Barnabas presenting how to measure ESG factors.
Yeah, hi guys. Again, I spoke a little bit earlier. I'm the EMEA director of sales strategy in investment advisory and ESG for Refinitiv, and as such, deal with a lot of ESG related requests and how they come together in the requirements of different market participants. Of course, impact is, as I said earlier, is a special data set within the ESG framework, and I believe it. You have to be sort of familiar with the frameworks that provide ESG data to be able to search for impact investment related data sets or proxies that are useful to basically show these kind of attempts or appetite of different companies. I don't want to get into the many challenges of ESG data, from basically being separate, mainly textual, part of being a PR tool, being infrequent, etc., etc. But it's enough to say, I think, that that's a little bit, because it's not standardized and hopefully is about to. There are a lot of perceptions, and it's actually very heavily relying on and data experts to extract the right information. And the three approaches that have evolved during the times of ESG is a sort of a inside-out approach, which is basically the company saying things about themselves and capturing that in two ways. One is the research-based approach, where serious subject matter experts are writing researches that might be a little bit subjective about a company's ESG performance, and highlight a couple of metrics that support that kind of analysis. And the other one is basically a more rules-based, quantitative based solution that basically provides a best-in-class trade rating that uses a set of metrics, in some cases multiple hundreds, and ranks companies along these metrics, and rolls up these metric ranks into category ranks, into E, S, and G pillar ranks, and finally, of course, into a common ESG framework. And the other one is this tends to be a little bit more frequent and provides more insights into the into the details of a specific ranking. However, it doesn't give any sort of expert research opinion advice. So if somebody is in need of that, then this kind of approach wouldn't be comprehensive enough for them. And of course, the third way is the outside-in approach, which is news and social media perception about a company's sustainability, ESG sentiment. And what's good with it is that it's very quickly updating. Of course, there is a lot of social media chatter going on that are confirmed or unconfirmed by news. So you can quickly update yourself. And if a company is in the wrongdoing or does something very positive, then you can basically immediately act up on it. The drawback that this framework has is that it doesn't really provide a transparent methodology how the sentiment is calculated, and of course cannot share all the underlying data with the consumer of this service because of the vast amount of sources and inputs that it uses. And it struggles to provide absolute nominal values when it comes, for example, to to CO2 emissions. You would be able to gauge whether it's increasing or decreasing, but you wouldn't be able to immediately derive whether what that is in tonnages. So these are the approaches, and we believe that if we say that, going back to my earlier comments, that large public companies can be instruments to impact investing if they themselves are engaging in impact investing. The sort of the inside-out rules-based or the outside-in approaches are providing the inputs for those decisions as such. Next slide, please. When we talk about ESG and impact as well, the main thing that we have to consider is that although companies who provide this kind of data have a clear framework, a sort of an empty Excel file on many metrics. In our case, this is around 450 metrics. However, we are heavily at the mercy of the companies reporting on those data sets and those informations, which is measured by the transparency. So it's a concept that is basically showing how many companies in somebody's database are actually reporting on a specific metric. So if I say that a transparency ratio of 60, and I have 100 companies in my coverage on my that I cover as per data, that means that 60 companies reported on CO2 emissions, for example. And of course, this can vary from industry to industry, from company to company, and of course it has different impacts whether the data is missing or not, because of course some of the data sets can be quite material, quite important from risk management or from alpha generation or risk or factor creation point of view. So you know, a bank not reporting on CO2 emissions might not be as problematic as a coal company not reporting on CO2 emissions. So hence why it's very important that we, when looking at ESG data, understand that transparency is a critical thing, especially if it's coupling with material missing data. And in our case, of course, we are working on deriving a materiality matrix, or we have derived one, and of course, stimulating companies on reporting more on the different metrics. Next slide, please. Which is basically just a little showcasing of how, although it looks complicated, how simply metrics or companies can be you know, rated based on different metrics. So what happens, for example, in our scenario is that we have 450 data points on a company, ideally, out of which we choose 186 and on these 186 metrics on one-on-one basis in every industry, we rate the companies against each other. And all those metric ratings ranks are rolling up into categories. Like, for example, in the environmental pillar, there are 3 categories: resource use, emissions, and innovation. And there are metrics that are describing the innovation category. So companies are ranked on an innovation or an emissions or community factor. And all these roll up into an ESG score, which is also overlaid by controversy, i.e. how a company is walking the talk, so to say. So how many negative news are surfacing about them. And if there are not too many, then basically the ESG combined score on the very top is going to be very similar to the ESG score. Or in cases when a lot of controversies are surfacing, then that ESG combined number can be way lower than the ESG score. And just a little representation of what we, for example, have as either direct impact or proxy impact measures. If you could go to the next slide, please. I brought to you about 20 of those. So when in our framework, these are metrics that we collect information on. So for example, biodiversity impact reduction, environmental restoration initiatives, whether they are global compact signatories, whether they aim to do toxic chemicals in a reduced manner, whether they are initiating any eco design of their products, whether they have a policy on fair trade, etc., etc. So these are quite good proxies. And why it's important to look look closely at the numbers, because or these metrics, is because, for example, in the MSCI World Index that we cover to its entirety as per companies, when companies who report say that they have a policy for community involvement, that's around 95%. So basically, about almost all the companies who we track in the MSCI in this index itself say that they have this policy. However, if you go on to the next metrics, so for example, look at eco-design of products or environmental project financing, those kind of ratios, transparency ratios, are dropping seriously. So you would be able to gauging a company's true commitment to community or to impact by looking at the more detailed metrics. And as with that, I believe I can conclude my sort of introduction, and thank you for your attention, and of course happy to answer any questions that may arise.
I think, being conscious of our time, we can move directly to the discussion section. Maybe we can pick up some questions when we discuss about the key points. Also because I think some questions are related to the talking points anyway. You know, as I mentioned in the very beginning, there's a lot of impact investors talk about how to measure it, but still there is a lack of general standardization and consensus on the impact measurement. And what progress has been made so far? I mean, I did mention about a few key international organizations, which are, they are trying to help to reach industry consensus by, either talking directly to the main investors or doing surveys. But there still isn't one framework that everyone uses. What's your thoughts from your experience, both on ESG and impact side?
So, I mean, yeah, this has been something that's been a topic of conversation in the market for years and years. And I think there is movement being seen, and I think I see some emerging positive consensus happening at different levels. So some of these have been mentioned, Annie, in your presentation, but so the IFC launched their principles for impact management April last year. And really that is a helpful indication in terms of laying out a set of principles that an investor needs to adhere to in order to classify themselves as impact. So the IFC are trying to play their part in avoiding the impact washing that can occur, and ensuring that actually there is standardization and criteria around behavior and how you are integrating impact into strategy, decision making, monitoring, and disclosure verification. So that's at the principles level. You've then got then at the measurement level, which I think you see GIN and their IRIS library being probably the most used in terms of how you're consensus around what people are measuring. So within there, you'll find a library of indicators and some evidence that backs up why they are useful indicators to apply to your investment strategy. And can also, the more people use them, the more there's alignment about what we're measuring. And then the impact management project, which I think we're huge fans of, and it seems like you guys are too, really laying out the frameworks in terms of those 5 dimensions of impact that you hear, and kind of classifying different impact intentions, and having those classifications feed into your portfolio, actually identifying, there are different levels and depths to impact. Impact isn't really one bucket, and they've really made a lot of progress there. There's over 1,000 practitioners worldwide now kind of signed up and engaged in this. So those 3, I think, are really leading the way at different levels of consensus and doing a really good job. And I think they'd be the ones that I would certainly advise to kind of have a look at and keep your eye on and get involved in from an impact perspective.
Yeah, I think that there are easy parallels to draw on the ESG side as well. There has been a sort of a lack of standardization, and the EU taxonomy aims to sort of solve for that issue, at least from the European side. There is of course a challenge with this every time, because if you say there is one number, one rating, then of course you are prone to greenwashing. What does it exactly mean that you are, from an ESG perspective, a outperformer or an A+ or A? And on the other hand, the more metrics you throw at either investors or the general public, the more confused you get. So I think there has to be a sort of a understanding about a global number and what would need to be going to that global number or letter, and of course some kind of descriptive additional information based on the theme. So if somebody is climate interested in climate, then just provide a couple of greenhouse gas related measures, or if it's social, then just detail that. The other key to this, of course, with the lack of standardization, I think it's very much a responsibility of the data vendor to basically define what exactly they mean when they say, for example, scope 2 is easy, but when you say animal testing policy or supply chain policy. So yeah, in agreement that it needs to be done, in agreement that it is being done. Obviously, there are solutions that are provided to sophisticated eyes in this area.
I mean, just a couple comments to add, because I did a while ago have a call with IMP in order to get actually more details in terms of how to implement the whole framework. And like for me, the biggest challenge is to be able to adopt, well, to choose in the very first place the different methodologies that all the big players have been they've come out with or been implementing. It's to make it relevant to my own company, or I guess across private wealth management company also, because the audience is very different. Our client base is very different. They're not institutional clients. They don't necessarily have the same understanding of institutional investment in the very first place, but also they might want to have a deeper impact because this is the way for them to express their personal values. So it's the fact there is a lack of standardization means for us also having to choose one methodology, which is very different from all other ones. They're not. The methodologies are all very different. For example, because I was reading one of the questions of the audience, like how to quantify the social return. The way to quantify the social return is also really different depending on the methodology you adopt. For example, for the expected return approach, you calculate the SROI, which basically you assign a monetary value to the outcomes. But this is not necessarily true for other methodologies, for example, like theory of change. I think that's definitely one of the biggest challenges, like personally, like myself and my company has encountered in trying to build in the first place a process and try to implement the process. And with that, I would like to, it's pretty much also linked to the second question, which is basically what are the key differences between the impact and ESG data measurement. And maybe we can also show the third questions because both are quite interrelated. We can probably provide one answer. So what are the key differences in, when you collect data from ESG perspective and impact perspective, and does it, cost, does it represent the extra cost for the companies? Because when it comes to private investments, the companies are of smaller size. When it comes to listed companies, we're talking about blue chip names. So for sure, they have different resources. And from your experience, what have you seen?
Yeah, I mean, the difference between, and I'm really curious to know what Barnabas is going to say as well, because for me, the difference between impact measurement and ESG measurement in terms of kind of like the approach kind of doesn't need to and really shouldn't be different. I think going out and collecting data, being, kind of methodological about it, transparent about it, using it to inform your investment strategy going forward. Except I guess it goes back to your intentionality. So the ESG is there to ensure that you are meeting some minimum requirements that actually that you do no harm in these investments. And this is particularly pertinent as well, like in the developing world where, there's international, at local level, there's kind of, like laws and regulations might not be at the kind of standards that European investors might require. And therefore kind of going in and ensuring that there are minimum standards among these investments is really, really key. And it can have a huge impact. So in a way, it's a little bit sensitive to say, one is risk and one is impact, because I think it kind of downplays also what ESG can do, which is pretty fundamental risk management of ensuring a minimum criteria about which that we are treating people and planet, and that can have a huge impact. And I think in terms of approach, then I don't think it really should or needs to be different. Like good, going back to the principles previously around identifying what you want to measure, how is it going to help you make decisions, using methodologies that are aligned with others that you can implement effectively and in a repeatable way, and using that data to inform decisions. I mean, I think they can be applied across both. I can't actually remember what the second question was already.
If it's an extra cost for the companies.
Yeah, and I think this goes back to, I think I'd probably just make the same point that I made before of, yes, it is. And it is a necessary business cost that should be seen. And I think that, where if and it comes back to intentionality. I think if a company were to see this as a burden, an investment that they didn't want to make, I would start to question their intention. I think, you know, albeit we need to ensure that the cost, particularly where it is being put on the company, is proportional to their size and the investment that we are making. That is when it becomes a burden, I think. If either you're asking them to do measures that aren't useful to them, and I think therefore coming back to the question of who pays, if it's a data point that's useful for the investor needs to pay. And if it's a data point that is going to drive performance of the company, then the company should see value in that. And that's probably oversimplifying it, but that is how I would see it.
I would concur in both aspects, you know, and maybe just emphasize the sort of the intention level with ESG. However, if you really call ESG or start calling ESG as sustainability, which it really is about, then the two things, the sort of the beginning and the end, come together. You know, you have intention as a company to provide more sustainably. You know, these kind of projects that you are doing during your value chain are basically the manifestation of that intention. And of course, what 60 Decibels are doing is basically measuring that kind of manifestation of intention, whereas we measure the intention as such, or you know, the ESG data sets do measure rather the intention, and try to do that in a forward-looking basis. And on the ideally, actually, I don't like these questions that this cost of ESG reporting. I mean, it's again, it's agreeing with Katie. It's a value question. I mean, doesn't it have a cost to put together a financial report? Yeah, but would anybody invest in you without the financial report? No. And that's basically the same with ESG. We have increasingly seen questions coming in from companies that you know, and that there are so many asset manager you know, intentions in the public space about this, that you know, they're going to divest from a certain year onwards from companies if they don't see the change. You know, BlackRock's sense of a purpose is just an immediate example of it. But there are other smaller players who did have similar pledges. You know, sooner or later, if you don't have a data set, you just will not seem to be credible, or there is not going to be any inputs for your credit rating changes, because let's face it, sooner or later this is going to be going into that kind of measurement. So you are going to be added another additional cost element and the risk element if this data is not available. So yeah, paying the annual you know, annual payroll of a sustainability or an IR officer to do such things, yeah, it has a cost. But would you get investors if you don't do it? I think it's you can count it on your one hand till that time comes that actually you won't get investors to do that.
I mean, from my perspective, I guess that's more from an investor perspective. We do actively engage with companies, you know, like when it comes to private investments, and they're like smaller companies. What I've found is like, it's for us, well, for all the investors, I guess, it's easier to have influence on companies which are smaller. When it comes to blue chip names, of course, it's less, we have less power in influencing their CSR policies, or, you know, I do understand all the big asset managers, they have their stewardship unit where their only job is to engagement with big companies in order to influence their strategies. But yeah, so it's, from that perspective, it is, yeah, it's definitely an issue. But also another point I would like to make is for smaller companies, they're less, because they have less understanding, and also they have different types of requirement from different types of investors, because there isn't a standardization in the industry. For example, family offices or fund or different impact funds, they will require different types of data, or at least in different formats. So for smaller companies, they don't necessarily have the resources and staff, for example, people able to, you know, do the same job, but just in different ways. Again, I think it goes back to the discussion we just had about the lack of illustration in standardization. So sometimes I do receive emails from entrepreneurs asking, okay, like, what is that you want to know from us from impact perspective. What does it mean, like, you know, providing impact data? And yeah, I think that's it's still a challenge for, especially in the private investment space and for small mid-cap companies. Yeah, I mean, with that, I would like to conclude, you know, the webinar today, because we're actually running out of time, and we still have a lot of questions to answer, but we'll address those questions in the emails direct to the audience. And thank you, Katie and Barnabas, for your insight today. And yeah, we will address, you can visit our website. You will have the link to the recorded session if you'd like to watch it again. And please feel free to ask more questions and send an email to me personally or to marketing team. We're happy to answer more questions. Thank you for your attention today and your time today.
Thank you all.
Annie, thanks all.